Assalamualaikum. Hello and welcome to Gurukul Online Learning Network. Today I'm your instructor Sheikh Mahadi. We're going to study Finance and Banking, Chapter 4, Financial Statement Analysis. So in the previous lesson, we learned about the profitability ratio. Now let's talk about the market ratios. What are the market ratios? Market ratio relate the firm's market value as measured by its current share price to certain accounting values. These ratios give insight into how well investors in the marketplace feel the firm doing in terms of risk and return. The risk and return ratios are always 1:1. They tend to reflect on a relative basis the common stockholder stockholders' assessment of all aspects of the firm's past and expected future performance. So the market ratio, all the math under the market ratio section are they try to expect the firm's future performance and the present performance they are always giving in. So let's take a look at our first math. Dividend per share, that is also known as DPS. See, dividend per share, DPS. So DPS is the dividend paid to the shareholders on a per share basis. So when a company releases its shares, people do not buy only one share. Sometimes they buy 5, 10, hundreds or thousands. If they are buying shares in an enormous amount, we have to consider that the price of share is enormously low. So that's a totally different topic. So DPS is the dividend paid in each share. Suppose I bought 5 shares and my dividend for each share is taka 5. So that's how the dividend per share works. So DPS is the net distributed profit belonging to the common shareholders divided by the number of common shares outstanding. So what are common shares? Shares are of different types: bonus share, preferred share, bonus, preferred, and bonus is 4 different subcategories. So common share is just like the normal share that people give out within normal rules and conditions or regulations. So that's called a normal share. When a common share is given out and the number dividend that a shareholder gets is divided among all of them in their each individual share. Suppose one has 5 shares, a dividend will be given into particularly 5 different shares. So the formula for the dividend per share DPS is dividend paid for common stock. That means dividend paid for each stock. And then number of common stock. That means number of common shares that each shareholder is holding. So dividend paid for common stock is 98,000 and number of common stock. That means total number of shares is 76,262. So if we divide that, we will get the dividend per share. That means the amount of money that is paid on a single amount of share, on a single share, the amount of money paid on a single share. So that is 98,000 divided by 76,262, that is 1.29. That means 1.29 taka is given on each share among all the shares that one particular person bought. So let's take a look at the second math. What is dividend payout ratio, DPR? DPR is also known as a payment ratio. It measures the relationship between earning belonging to the common shareholder and the dividend paid to them. A share can earn in 2 different ways. It's in one, the person earns through it, and the dividend that is promised to be paid at the end of each period or at the end of each year. Usually it is 1 year or 2 years in case of company basis. The time and regulation depends on various kinds of companies agreements. So the DPR shows what percentage of share of the net profit after taxes and preference dividend is paid to the shareholder. So the DPR tells us what will be the amount that will be given to me after I have paid the taxes and all the other kinds of preference dividend that is to be paid, like the liabilities or the taxes or the EBIT we learned, or the EAT, earning after taxes, earning before taxes, all the previous things we learned. So DPR is measured by that. After paying all those kinds of payments, after that when those dividend will be given to us in that period, in that process we will find out the DPR, which is dividend payout ratio. So preference to the dividend shareholder, it can be found out by dividing the DPS by the EPS. So what is DPS? DPS is dividend per share and EPS is earning per share. So let's take a look at the formula. Here, dividend payout ratio, the DPR, dividend per share, that means that the amount of dividend we're getting in per share. We just took it out is 1.29 dividend payout ratio. We solved it in the previous math. So dividend per share divided by earning per share, that means the amount we are earning in our per share. Dividend per share is 1.26. That means 1.26 taka will be given within our each dividend. It means in each share we will be getting paid 1.26 and earning per share would be 76,262. It's just some random common numbers will be taken into forms. So divide 1.26 divided by 76,000, we'll get 0.448. Convert that into a percentage, we'll get 44.48, almost up to a 50% raise. So let's take a look at the third math of the market ratios. Market ratios third math will be price earning ratio, PE, or in short form PE. The price earning ratio is commonly used to assess the owner's appraisal of the share value. The PE ratio measures the amount that investors are willing to pay for each amount. The PE ratio measures the amount that investors are willing to pay. That means suppose a share is released in taka, each share's value is taka 1 lakh. Some people are not willing to, then they release a share of taka 70,000. Then some consumers are saying it's too low for a share. Then they will just sit in a meeting, they'll compare between the prices and take it up to a range where people will be willing to pay happily for that kind of show. That's why how we'll get the EPR or the PE, price earning ratio of each value, of each share. So the level of PE ratio indicates the degree of confidence that investors have in the firm's future performance. As we said, the management boosts it, everything, it working time, hours, capitals, everything, to boost the firm's profitability ratio and take other people's trust and confidence. So that's how within the PE ratio, within doing the PE formula or the price earning formula, investors will get the confidence that how will the firm will be doing in the future and how it is doing currently right now. So the PE is mainly, it will tell us about, it will foretell about the company's future performances. The higher the PE ratio, the greater investors' confidence. So that means the more the PE ratio is of a company, the more the investors will be willing to pay in your company. So let's take a look at the formula of the price earning ratio or the PE. So here is the price earning ratio of the PE. Market price per share and EPS is earning per share. Market price per share is 32.25. The price of each share is 32 taka only, 32.25, and earning per share is given 2.90. That means it's a random number. You can take any kinds of number, or it will be given in your math solutions. So earning per share is EPS 2.90. Divide that simply, 32 divided by 2, that will be 11.12 taka. 11.12 is earning per ratio. That means in earning per ratio or the earning per shares, as we can say, that's how within the more the value is, the more the ratio is, or more the percentage is, the more investors will be willing to invest in our company. So this figure indicates the investors are paying 11.2 for each of taka 1 earning. So let's take a look at the next one. Market value or the MB ratio. Market value is short form for MB ratio. Market value or the MB ratio. So what's the market value ratio? The market value provides an assessment of how investors view the firm's performance. In the previous one, in the earning PE, we thought or we gained the knowledge about how the firm will be doing its performance in the far future, and the market value says provides assessment of view firm's performance. That means the firm's current performance is taken through the MB or the market book ratio, and the firm's future one was taken by price earning ratio, the PE ratio. So it relates the market's value of the firm share to the book strict to the accounting values. It relates market value of the firm share. That means the amount of share that we sold out into the market. That means each share has its own market value, and these all assessments follow due to a strict rule of the accounting principles. So let's take a look at the formulas. Market book ratio, it will be market price per share and book value per share. That means book value, when a share is released within the company, it has a certain value, but when it is to be released in a market, sometimes the price has to be up and sometimes the price has to be down. So that's why market price and book value per share, those two are totally different in totally different two cases. So market price per share would be 32.25 as previous, and book value per share, which is within the company, it will be 22.20. Just divide it simply, we'll get a 1.14 MB ratio. So 1.14, it won't be in percentage, it's just 1.14. That's the all answer. You don't need to take it as a percentage or taka or into the ratios. So MB ratio means that the current investors are currently paying 1.40 for each of taka 1.00 of book. So That's all about our market ratio discussion. If you have any kinds of question regarding this class, please let us know down in the comment box below, and be with Gurukul. Thank you.